Good morning and welcome to today's webcast, Not-for-Profit Tax Update, Spring 2019. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Patty Mayer, Director, and Lauren Haverlock, Senior Manager. And with that, Patty, I'll turn it over to you to get us started.
Okay, thank you, Emily. Okay, so for today, our agenda, we're going to be going over recent developments. We're going to talk about the TEGE Workplan, some data-driven approaches being used by the IRS, Priority Guidance Plan, the effects of the Tax Cuts and Job Acts, kind of where things are looking, Senator Grassley, mentioning him, and then recent bills introduced. Then we'll jump into tax reform updates and developments, going over unrelated business income bucketing, fringe benefits, net operating losses, international provisions, university endowment tax, and compensation. First polling question. Emily, back to you.
All right, our first polling question for today. In looking ahead at the next year, what are your biggest tax compliance-related concerns? And your options are transportation or parking fringe benefit, 21% excise tax, UBI reporting and bucketing, IRS examinations, payroll tax issues and exams, or all of the above. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit Submit. If you're having any difficulty seeing the poll, you may try refreshing your browser. All right, let's go ahead and take a look at the results. Patty, back to you.
Okay, it looks like a lot. We're kind of across the board with the first transportation fringe benefit, UBID bucketing, and then all of the above. We're split pretty evenly. So yeah, there's a lot for us to think about these days for sure. Okay, so the first topic is the TEGE, tax-exempt governmental entities work plan. They've actually changed the name to a fiscal year program letter. And the IRS and TGE, they come up with compliance programs. And there are 6 of them listed here. Compliance strategies are how they prioritize and allocate resources within their population. So they get suggestions from employees, and they try to look at areas that they really need to drill down and focus on. We have another slide on this one. Data-driven approaches. This is how the IRS is really collecting data and using it with certain queries to try to identify non-compliance and issues that are out there. So we'll go into that a little bit deeper. Referrals, claims, and other casework. Referrals come in with alleged non-compliance that a tax-exempt entity is doing, and the IRS definitely takes a look at that. They also look at claims for refunds and penalty abatement, things like that. Compliance contacts, this is where the IRS has gone to this for a while now, but they're primarily using, because they have limited resources, and so many people have been retiring and leaving the IRS, so they've gone to a correspondence contact known as a compliance check. And if you get a letter from the IRS asking a whole bunch of questions, you definitely cannot ignore it. You need to respond to it. Depending upon how you answer, they may or may not turn it into a full examination. So take those pretty seriously, and you should be good. Determinations is another area that the IRS is focusing on. This is where they issue exempt status to organizations that submit the Form 1023, 1024, or 1023-EZ. So they're expecting a continued increase in applications that are coming in, and they're trying to reduce their time to process. So they're actually hiring 40 new revenue agents, if anyone's interested, to work in this area. Voluntary compliance and other technical programs. Voluntary compliance, or VCAP, these are programs that the IRS starts to have an organization come into compliance, pay a fee, just say, hey, I want to do this right. And it's out there right now for benefit plans, for corrections of any plan failures. Okay, so compliance strategies that they have right now, the top listed here, are Section 501c7 social organizations. The IRS is focusing on their investment income, non-member income, and non-filers that don't file a 990T to report unrelated business income. They're also looking at organizations that used to be a for-profit that have converted to 501c3 status. Private benefit and private inurement. They're looking at indicators that it's reported through the Form 990 or 990-PS on areas that there might be inurement going to the individuals or private entities connected with the organization. Early retirement incentive plans, they're looking at those. People can leave early. Form W-2 1099 matching. This is where they're looking at this, what's reported on the 1099, what's reported on the W-2s, should FICA have been paid with that. They're concerned that Social Security may not be funded or there's misclassification. And then the next one, mismatch or missing TIN numbers for backup withholding, and worker classification is should you have been reported as an employee versus an independent contractor. Data-driven approaches. The IRS has really been working on this for a long time, and they're getting pretty good at it, and this is what's creating the compliance checks. They have over 250 queries and queries that they look at to identify non-compliance. They're looking at your Forms 990, the 990-EZ, and the 990-PF. We don't know what those 250 search queries are, but what it could be things like failure to file a complete return. Maybe your missing a schedule or the EIN is a mismatch. You've reported a significant diversion of assets because of fraud or embezzlement. And this is a question on the 990, and you've responded yes to that question. Maybe your 990 indicates that you had unrelated business income, but you're not filing the 990T. Was there an excess business transaction with a disqualified person? You're reporting wages and consulting expenses, but you haven't filed enough W-2s or 1099s. They can pull in that data. So things like that. They could even take it to a percentage analysis, like percentage of compensation to total expenses. Does it go outside of a range that they're comfortable with? Just a trigger thing, and it may be nothing that is happening that is wrong. Or private ennormment, is there business relationships or loans receivable from a disqualified person and there's no change in the balance due from that disqualified person. So this gives the IRS a lot of information, and it helps them set up their queries and exam approaches. Then the data-driven approach also is looking at the W-2s and 1099s that I mentioned before. And so they're getting good. And electronic filing is helping them, which is mandatory for large organizations with 10 million of assets or 250 filings, like W-2s, like every filing that goes 1099s. If you're at 250 and 10 million, you're required to e-file. Under data-driven exams, this is per their letter, their program letter, but they have finished 7,917 compliance contacts. They had 6,600 examinations. 4,900 of those related to exempt organization issues, and 1,700 were employment tax exams. And out of those, they had 1,317 compliance checks. So they're estimating the data-driven approach from the 990 generated 60% of the closed examinations, and the remainder were mainly from referrals and claims. The priority guidance plan, this is issued, it's under a fiscal year, so they just, it's for July 1 through June 30. There is 239 projects, 45 new ones that came out in October of 18. And ones that are affecting the nonprofit areas, we need so much guidance with the Tax Cuts and Jobs Act. The first one listed is the compensation excise tax that we're going to go over under tax reform. An excise tax for private colleges and universities, which was added. Guidance on qualified transportation fringe benefits, and all the parking and everything. They've given us some guidance on that. Employer-provided meals, and also guidance, it's not on the list, but guidance relating to the siloing of unrelated business income. We'll go through. Right now, if you take a snapshot picture of the effect of Tax Cuts and the Jobs Act, what they're looking at, if you look at last year to 2018, is that the individuals are actually, their taxes have increased. If that's an up for individuals. Corporate tax has gone down, which that doesn't sound surprising because it went to a flat 21% rate. Social insurance taxes, those went up slightly, which makes sense because the individual tax is up higher as well. Excise taxes up, estate and gift tax down slightly, and then other taxes down slightly. Okay. If we think of tax reform and effects to the charitable sector, right now it's estimated charities will lose about $17.2 billion in donations in 2018. That's a 4% reduction. It's estimated 21 million taxpayers will not be able to claim the charitable deduction, and that the top 9% of taxpayers are the ones that will get the deduction. So it's really skewed to higher income taxpayers that can itemize. And as you all are probably aware, the Tax Reform Act, it doubled the standard deduction, and it had limits on state and local taxes and the mortgage interest. So a lot of taxpayers don't have to itemize for federal. But don't forget about your state taxes. You might be able to get some benefit itemizing there. So there's concerns that, how do we get donors to contribute if only the high-income donors are contributing? And also, if you think about it, if nothing gets really changed here, our people, donors, your donor base, are they going to be looking at other avenues where to put their money? There's a lot of crowdfunding going on. It may be instantaneous funding here, there. So there's a lot of things organizations need to attract donors, and maybe at smaller amounts, more donors, but a lot of planning needs to happen if nothing changes. Looking at bills coming up, there is the Tax, Clerical, and Technical Correction Bill, and this is modifications and corrections to the act that went into effect 2018. It's considered part of the original legislation, so it doesn't have a cost associated with it. Policy change, which is not a technical correction, the repeal of the Transportation and Parking Section 512A7, that's in this category, unfortunately, and the cost of this repeal is estimated to be $1.7 billion over 10 years. So right now it's felt it's highly likely it's not going to be repealed unless this lost revenue is replaced with something else. So that being said, you'll see in a minute there's a lot of bills out there trying to repeal this. Another policy change is the repeal of the Johnson Amendment, and they have a cost associated with that, $7.7 billion over 10 years. And that one is where a 501c3 organization can make statements relating to political campaign in the ordinary course of their business. Senator Grassley, he replaced the Senator Orrin Hatch as chairman of the Senate Finance Committee, and he's been very vocal in the nonprofit sector over his career. He's done studies of colleges and universities. He asks a lot of questions. He really wants to hold the IRS accountable to top quality service. There's some little bit of information there about him. He's asking questions to the IRS to enforce right now Section 501R. This is a section relating to the hospital area where they have to conduct community health assessments, establish financial aid assistance, and not overcharge for emergency, and not do billing, like really crazy billing and harassment to people to get them to pay. He also has introduced a bill for the tax extenders and disaster relief, and this would provisions that were expiring in 2018. He's trying to get extensions on those. So it's a lot of different credits and extension of a whole bunch of relief, an Indian employment tax, mine rescue team training, a whole list of things. One of the bills right now that's passed the House so far in March of 2019 is For the People Act. And this act would relate to campaigning, related distributions exceeding 1,000. So what it's doing is if you're an organization that's not a 501c3 and you have made disbursements over 10,000, they want the name and address of all the campaign activity, disbursements of candidates that it went to, and a certification that it was a voluntary contribution. A universal charitable deduction, this one, HR 651, this was introduced February of 19 by the House Committee, House and Ways, and it wanted to amend the charitable deduction to let all taxpayers have a deduction regardless of whether they itemize, to encourage and increase charitable giving. And this is what we'd call above-the-line deduction. So a straight deduction, not having anything to do with your standard deduction or itemize. Another bill, HR 651, Charitable Giving Tax Deduction. This one would also provide for a charitable deduction regardless if they itemize or not. So the House has two out there right now. Nonprofit Support Act. This one would amend certain rules, and it's trying to hone in on the separate siloing of separate activities, separate trade or businesses, repeal that, and repeal the parking and qualified transportation provisions that are in there. List for Charities Act. This one also is trying to repeal certain fringe benefits and the disallowance on, so if you have fringe benefits and they're taxable and there's a disallowance for the deduction in unrelated business income, but Lyft is kind of funny because it's transportation and it could almost, they need an Uber acronym too because this is supporting Lyft. Just kidding. Then HR has another one, 1223 in the Senate, 501, and this is Stop the Tax Hike on Charities and Places of Worship. And it's the same theme as we've heard on the other ones. It would be modifying requirements, repealing the provision that UBI is increased by the amount paid for fringe benefits, and the disallowance of parking in on-premise athletic facilities. The HR one also is trying to increase the corporate tax rate to from 21% to 21.03%. And the Senate bill is very similar to the HR bill, but the tax rate increased from 21 to 22%. So they're trying to find more revenue to offset the repeal, like how I said before. They need some sort of money coming in to help with the offset. So what else is out there? What might come in? Preserve the charities, the Senate Bill 1282. That's a bill out there. Repeal of the 4960, modification of endowments for colleges and university. And the other one is that we're seeing is reintroduce past legislation, the Charities Act. That actually was reintroduced on May 15th this year. It's called Charities Helping Americans Regularly Throughout the Year Act. And what this would do is some of the highlights on this one is the standard deduction, the standard mileage rate for charity volunteers. It would have that rate be the same as the same rate for medical and moving. It would require all 990s to be e-filed, whether you're small or large. So the IRS likes that because they have their data-driven approach. For donor-advised funds, they'd be eligible for receiving IRA rollovers. They could go into a DAF. That could be really attractive for a lot of people that have to take out IRA money and don't know where to put it. They could put it in there. But also in the bill, they have a modification for DAF disclosure. So if you're a community foundation holding DAFs, in this bill, they'd want to know the number of DAFs in existence over a 36-month period and the number of DAFs during this 36-month period that have made grants. And they want to make sure there's a policy when a DAF becomes inactive, and is the policy being enforced. And the last one on this recap is the private foundation excise tax. reducing the rate to 1%. Right now it's a 1 or 2% computation. That's kind of tricky to calculate, but in some organizations it would just simplify how they can plan for their payouts, and they would know what tax rate they have. That would be very welcome. Okay, well, moving on to tax reform. So there's some recent guidance under the major provisions that are hitting exempt organizations. Under Unrelated Business Income and Notice 2018, 67 came out. We'll talk about that. Fringe benefits, there's three things listed there. The last two came in December of 2018, and it was very welcome because we needed guidance terribly. Endowment excise tax has some notification, and that excise tax is reported on the Form 4720, not the 990T, as well as the compensation excise tax. Okay, polling question, Emily.
All right. Our second polling question: how familiar are you with the recent guidance provided by the IRS related to the Tax Cuts and Jobs Act? And your options are: I've read them all front to back, I've scanned through them, I've read a few blogs, thanks Moss Adams, or I rely on my advisor to interpret these for us. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a few more seconds to respond. And let's go ahead and take a look at the results. Back to you.
Okay, all right. Read a few blogs, is pretty high up there, and rely on my tax advisor or your advisor. Okay, very good. Okay, activity bucketing. What this relates to is, and this is a brand new concept that exempt organizations are having to deal with, but if your organization has more than one trade or business activity that it's doing within, like say you have advertising going on and you have investments in partnerships, those would be considered separate activities. And the partnerships, Lauren's going to go into that, because you could have multiple activities within your partnerships possibly. But what it's saying is income from one activity cannot offset the losses from another activity. You have to silo them and look at it separately. This applies to tax years after 12/31/17. You still get all your deductions that you can offset against your income, and there is still the $1,000 exemption that's applied against your taxable income. So that nothing's changed there. If we look at this slide, actually provides a really good example of what I'm trying to explain. So in this example, your overall loss for the year was $165,000. Under pre-tax reform, so before 12/31/17, you would not owe any tax. You'd have a net operating loss carry forward or carry back 2 years of $165,000. But now with tax reform, you have to pick up the income items. So you're picking up the website income, printing services, and disallowed fringe benefits. So instead of having a loss of $165,000, you have income of $337,000 and a tax of almost $71,000 that you weren't planning on. Your net operating losses are now separated to follow the activity. The K1 has 462,000 NOL, and the rental activity has a 40,000 NOL. And now that loss that was generated is limited to 80% of income. It can't go to zero. That's new. So with the business side, this UBI siloing, we had so many questions on how do we even figure this out? What are they going to consider separate activities? Well, they have a new, the 990T for 2018 is now available, and they've added a Schedule M. If you have more than one activity, Schedule M will be filed one for each activity. And it really mirrors page 1 of the 990T, but it's per each activity. So there's been some guidance that's come out and suggestions, and use a reasonable approach. What makes sense is out there too. But some ideas are, well, what if you use the NAICS code for siloing? How about debt financed income, controlled groups, investments? Lauren's going to talk about that. Fringe benefits are not considered a trade or business, which is actually in our favor because it's not siloed, and if there's a loss from, you only have one activity and you have a loss, it could absorb that. Net operating losses, those rules have also changed. We have a slide going over that, and GILTI is some international provisions that we're going to talk about briefly. So Lauren, pass it over to you.
Thanks so much. So as if bucketing isn't complicated enough, it gets a little bit more complex when you look at your investments. So for organizations that have investments in partnerships, so if you're a partner, a direct partner in a partnership because of how you structure your activities, or if you have alternative investments that are partnerships, the IRS has historically treated income that flows through those K-1s that you receive as a partner, and especially the trade or business activity, as though the nonprofit is directly undertaking that trade or business activity. And so how does that impact bucketing? So if you're invested in alternative investments and some of those have oil activities, you as a nonprofit may have to, in theory, report that activity as its own separate bucket. However, we got some guidance from the IRS in Notice 2018-67 that specifically speaks to these types of investments and partnerships. And it provides a little bit of a relief for organizations regarding these types of investment activities. It allows organizations to aggregate their investment activities from partnerships. In certain cases, if they're not significantly participating in those activities, which I'll go into that definition in a bit, with other investment activities that they have that are unrelated business income. So we would typically see that as debt-financed investment income. Usually that's unrelated business income. So if you have that debt-financed investment income and you have revenue from limited partnerships or K-1 income from limited partnerships, you're able to aggregate those partnerships together, all that income as one unrelated business income activity. So how is that defined? If we look at our partnership interests, and let me progress the slides. If we look at the notice 2018-67, one of the sections goes into the partnership rules. So generally, as with all of these notices that we're talking about, these aren't actually law yet. There's not regulations that define how an organization should do this. So really what the IRS says in all of these cases is you use facts and circumstances to separately identify trade or businesses until proposed regulations are issued. Now, what are some of the things that the IRS is recommending? Well, there's two different things that we need to look at. For partnerships that were acquired before August 21st, 2018, these can all be, each one of those K-1s, that's going to be considered investment activities, and it can all be aggregated together as investment activities. You don't need to consider separate trades or business within each K-1 for those. If you have acquired a partnership that was acquired after that date, there's two different tests that you need to either or test. So you can either meet the de minimis test or the control test to determine if that K-1 has significant participation. Just as a reminder, if you don't have significant participation, you can lump together that K-1 income, all of it, every line on that K-1 as investment activities. If you do have significant activities in that K-1, significant participation in that K-1, in that partnership, and that could be defined by the de minimis or control test, then those have to be considered separate buckets.
So there's just a little illustration that helps show that you may aggregate all of the qualified. So if you have 56 limited partnerships and 55 of them meet the de minimis or control test, they're all considered one UBI activity. If the 56th one doesn't meet that, it is considered its own activity. And then any other trade or businesses would be their own separate activities. And this is not applicable for 501c7 organizations. They have their own sets of rules for this. So what is the de minimis test, and how do we take a look at this? De minimis is if your organization holds no more than 2% of the profits and interest, and 2% of the capital. How do you find that? How do you know that? And it kind of fluctuates for a lot of these investments throughout the years. How do you know that? Is by looking at your K1, Part 2, Line 7. There it should be a beginning of the year and an end of the year interest in that K1, in that partnership. You just would average those two together, and that would give you your interest through that year in both the profits and the capital interest. If you don't have that information, if that information is blank on your K1, then you can't meet this test. If you don't know that information, you can't meet this test. One of the things that makes this a little bit more complicated is that it's not only what the filing organization or your organization holds in these partnerships. You also have to include related interest, and it has to be combined for this test. So that would be the interest in these investments of any disqualified person, supporting organization, and controlled entity. Supporting organization, it would be an organization that supports your activities under 509A3, and a controlled entity would be any organization that you have a controlling interest in 50%. Generally, as an organization, you would have insight into these activities of these organizations, but the disqualified person provides a little bit of complexity for organizations. Disqualified person could be your officers, directors, trustees, key employees. It could be significant donors to your organization, large donors, excess contributors. How is our organization supposed to know what these disqualified persons are invested in? We don't have that guidance yet right now, but what we would look to is the reasonable efforts requirements that we already have in the Form 990 instructions. This says that if you're required to get third-party information from, other organizations, and this isn't just disqualified persons as these people, it could also be their family members, organizations that they control, and, if you're a donor advised fund, those donor advised fund advisors. That is a little bit of a burden for organizations themselves. So, we would expect a reasonable efforts questionnaire. Maybe if you're providing conflict of interest questionnaires and other questionnaires, asking about board relationships with an organization, you would include a question about investments and provide that information. But as I noted, we don't have a lot of information in the notice as to how to determine what the related interests are of these disqualified persons. So that's the de minimis test. There's also the control test. This is an either or. If you don't have either de minimis and de minimis interest, nor do you have control, then these would not be considered significant participation activities. So the control test is that the nonprofit holds no more than 20% of the capital interest and of the organization, and does not have any other control or interest over the partnership. And that would be based on facts and circumstances. So the notice goes into a couple scenarios where there could be control or influence. So if the exempt organization can require the partnership to do anything, or the exempt organization's insiders have the ability to participate in management, then there could be considered control if you also have 20% of the capital interest of an organization. This one also has the same requirements for the related interest combinations of that we just discussed in the de minimis test. So those are the two. That's with the aggregating of the partnership rules, looking at your partnership investments and how to determine UBI bucketing. And that brings us to our next polling question, which is about our next topic and change for the Tax Cuts and Jobs Act. So I'll throw that over to you, Emily.
All right. Our next polling question: what best describes your current employee parking situation? We don't provide a parking lot or any parking for employees. Everyone has to fend for themselves. We own or lease property where parking is provided free of charge to the employee. We pay a third party for parking on behalf of our employees. We pay a third party for parking and deduct it from our employees' paychecks pre-tax, or we pay a third party for parking and deduct it from our employees' paycheck after tax. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says Slide Deck and Handouts to the right of the slide view. And let's go ahead and take a look at the results. Lauren, back to you.
Thanks so much. So it seems like a lot of organizations, the biggest answer is that we own or lease property where parking is provided free of charge to employees. Spelled incorrectly, but that's okay. We're accountants, not writers, apparently. So taking a look at one of the other changes from the Tax Cuts and Jobs Act that is really applicable to a lot of exempt organizations. Whether or not you have to pay this tax, you have to take a look if you have employees as to if you provide any of these types of fringe benefits to those employees. So this would be the Qualified Transportation Fringe Benefit and on-premise athletic facilities. And something that we've talked about and you've probably spoken about with your advisor or taken a look at is what type of fringe benefits do you have that now become unrelated business income tax because they're considered non-deductible benefits. And so for organizations, this is effective as of 1/1/18. And there have been, as Patty went into before, there's been a couple attempts to repeal it, but nothing's actually happened to date yet. We did get some information as to how to calculate and figure out this item, which is, an organization's expenditures that then flip and become taxable income to those organizations. And so that's something that we'll go into a little bit when we talk about Notice 2018-99. One of the things that we're talking about a lot with this is transportation fringe benefits. There's also another part which is on-premise athletic facilities. And on-premise athletic facilities is something that's not really applicable to most organizations because as it's been clarified, this would be for organizations that provide on-premise athletic facilities only available to highly compensated employees. So it's not if you're a university and you have a recreation center that employees have access to, that wouldn't be included here in an on-premise athletic facility. It would just be one that you have limited to your executives and highly compensated employees. So what we're going to do now is we're going to refocus really on these transportation fringe benefits. And what we're seeing is really three different buckets, I think, as you saw from that last question. There's, of course, all types of scenarios out there when it comes to parking. But we're seeing really three main buckets that most organizations are facing. And that's when an employer pays a third party for parking, transit passes, or provides them free for employees. And that's a cost to a nonprofit organization. The next one that we're seeing is that the cost is on the employee. The employee has to pay for their own parking, but it's allowed as a payroll deduction pre-tax. So that employee gets to reduce their taxable income in their paycheck by that expense for parking or transportation benefits. The last one is that, it's kind of invisible to the employee. They're not getting, a third-party parking pass. They're not reducing their tax by it, but the nonprofit has a parking lot that the employees can park in. That parking lot may be owned by them. It could be included as part of their lease arrangement, and that the employees have a parking lot. So there's with this, there's three different ways to handle it and three different things to look at. But taking a look at the parking and fringe benefits, parking we'll go into in a second, but qualified transportation fringe is also something that becomes unrelated business income. And a qualified transportation fringe would not just be parking, it would also be if you provide any commuting benefits to employees, like a carpool vehicle for them, transit passes. There are some cities that require supplemented transit passes for employees. That's now UBI from a federal perspective. Qualified bicycle commuting expenses, if you provide that free for employees, up to $25 a month, that's no longer a tax-free benefit for those employees. And then outside of those qualified transportation fringe is also lumped in parking facilities used in connection with qualified parking. That's how we get that parking lot lumped into these parking and transportation benefits. Looking at parking and transportation, organizations have all types of different situations, but transportation would really be something that if you're providing that benefit to your employee to get from their home, from their residence to their place of employment. So if you have, a campus where there's a bus that circles around campus to allow you to get around campus, that transportation system isn't an expense that helps commuting from home to work. So that is likely going to not be considered a transportation expense for which you have to include as UBI. If you have a bus system available for your students or patients or other members of your campus that you have, and most of that is expected to be actually less than 80% is for employees, most of it's expected for those students and patients, then that one is going to also, not be considered transportation for this UBI issue. One thing, what we've talked about, some other examples, is that what happens if you have an employee lot off campus where all your employees have to park, and they get shuttled from that lot to the facility. Is that a transportation expense because it helps them get that last mile? Also, buses that go from the metro line to campus, you'd have to evaluate those to see who uses those and whether or not those would be considered mostly for your employees commuting. Jumping into Notice 2018-99, this is what helps define your parking related to transportation. This takes a look at specifically parking to say, how is an organization who provides parking to employees in any one of the buckets, whether you pay a third party, whether you own a lot, how is that parking how do we calculate that amount? Well, Notice 2018-99 provides information that if you pay a third party for your parking, right? So if you are in a downtown area and parking is at a huge premium, and so it's $100 a month per person to park, and you pay that parking lot operator so that your employees can park, and you don't have it run through payroll, just pay it. That $100 per person per month that you pay, that all is going to be added together for the year and be unrelated business income, so you'll have to pay tax on that. The notice doesn't address pre-tax deductions. That's actually addressed in another publication 15B. But if you, remit that payment but your employees have to reimburse you through a pre-tax deduction, that doesn't get around this being UBI. If your employees deduct it pre-tax on their payroll, that's also considered unrelated business income for an organization. 2018-99 goes through some questions. It goes through a process for organizations that lease or own a parking facility or lot, because that's a lot less clear as to how to determine what the cost of parking is when you own a parking facility or lot. The first thing that this notice says is you can use any reasonable method to figure out what cost you're paying for employees if you own a parking facility or lot. They do note that one thing that's not a reasonable method is going to the fair market value of the parking. So for an organization that might be in the middle of the country where land is freely available and anyone can park anywhere, you can't look to the fact that anyone can park anywhere and say that there's no value to your parking and say that there's no cost to parking. You really do have to look at what you're expending on an annual basis for parking. So the reasonable method will go through what that reasonable method looks like. It's a 4-step process. And one thing to note is that this 4-step process will have to be done by geographic location. So if you have multiple offices, multiple locations for employees, multiple campuses, you'll have to evaluate the facilities by geographic location. Geographic location is generally defined as a city in this case, and add together what that parking is per location, per geographic location. All right, so what are the steps? We've kind of gone through this And you probably heard this, so I'll just jump through this facility knowing that we only, or this calculation knowing that we only have 10 more minutes of time left. But the first step to this is that you look at if you have any parking spaces that are reserved for employee use only. That would be anything that would be designated by signage or access or barrier to entry. And if you have any parking that's reserved for employees only, then you will have to calculate what that cost of that parking is as UBI. So you would then take a look at that ratio of parking lots to say, and we'll go through some examples, but the cost for that reserved space is unrelated business income. Step 2 is then you remove those spots, those reserved employee spots, and you look at the remaining spots that you have. And of those remaining spots, what's the primary use of those remaining spots? So if you had 1,000 spots, 100 were reserved for employees, and then you're looking at your remaining 900 spots, if more than 50% of those spots are for the general public being customers, clients, visitors, empty spots are considered for the general public, congregates, anything like that. If more than 50% is for the general public, then you're done. You have no more UBI. Your UBI is limited to what is reserved for employees only. If you look and see that less than 50% are for the public, more than 50% is used by your employees, then you have to move on. There's nothing that's calculated in step 2. There's no UBI calculated in step 2. This is just a determination as to whether you move on or whether you stop. So if you do have less than 50% for general public, you move on to step 3. What you do in step 3 is you take the remaining spots and determine how many of those spots are reserved for non-employees, for your patients, your customers, your visitors. And those reserved non-employee spaces, the costs associated with them are pulled out as non-taxable. So you've already pulled out some taxable related to your reserved employee. Now you're pulling out costs as non-taxable related to your non-employee use. And you have a remaining pot of costs, and you have to basically go to step 4 and calculate of those remaining costs, how much are allocated for employee use and how much are allocated for non-employee use. And this is your non-reserved spots. How do you determine that? It's very difficult. Reasonable methods is how we recommend, but it's difficult for organizations that might be, if an organization has typical business hours, 9 to 5, it might be a little easier to take a look from 9 to 5 what employees are physically there. But if you're a hospital and you have 24-hour services and employees coming in at all hours of the day and going at all hours of the day, it's any reasonable method, taking your total number of employees and dividing them by shifts and looking at how that works, looking at the number of spots to the numbers of employees, looking at hours of use by employees with total hours of use of the parking lot. Any of those reasonable methods could be used to help determine it. We have a couple examples here. I won't go through them, but they're pretty helpful if you have any questions about that process for determining what those, how to allocate the costs. But looking at parking expenses, repairs, maintenance, this is a list of items that could be included as parking expenses. The one thing to note is that depreciation doesn't show up on here. That's not considered a cost added in for parking fringe benefits. I want to note one other thing is that Patty said they released the 2018 Form 990T. On that updated Form 990T, we do see those separate schedules for different buckets, UBI buckets. One thing that we also see is that parking fringe benefits are kind of like a below-the-line tax. So there's no ability to offset costs against this. Your parking UBI is below your buckets. It's calculated and considered outside your buckets before the application of any old NOLs, which we'll go into NOLs in just a second. But it's not its own bucket. You don't have any costs that go against it. You just report your parking UBI separately at the bottom after all your other buckets have been figured. So unfortunately, there's no way to reduce this UBI, this unrelated business income. It's just kind of more like an excise tax in a sense. So there were some in a notice 2018-100, there were some elements of relief for organizations, and that's something that basically, sorry, I skipped ahead. That would be if you have estimated tax liabilities and you didn't know that you might have it, you have some relief for your estimated tax liabilities. All right, so quick look at net operating losses. The net operating loss rules have changed. Previously, they had a 20-year carryover, a 2-year carry back, and they expired after 20 years, and they were allowed to offset 100% of your taxable income. Now, looking at the last box on the furthest right, the new rule for NOLs is that there's no carryback, and they're good forever. They're an indefinite carry forward, and they're limited to 80% of taxable income in the year used. One other thing to note is that they're also limited by buckets. So now you're going to have a pre-Tax Cuts and Job Act NOL bucket. Those are good against any buckets of UBI. They're good only for 20 years, though. And you're going to have a post-Tax Cuts and Job Act NOL, which are all going to have to be separated by buckets with an 80% limitation on those buckets, indefinite carryover, so they're good forever. That can affect financial statements. If you prepare financial statements and you have a significant NOL, we used to sometimes write off the deferred tax asset that came from an NOL because it would expire before we use it, but now they never expire. So how does that affect the write-off? And then if you're a fiscal year-end filer, there's kind of a funny thing that happens, and you have a special transition rule for the 1 year, but that's very specific to those organizations. So quickly, right before we end, do you have any international activities? I'll throw it over to Emily to complete this this question.
All right, our final polling question. Do you have any international activities? And your options are: we don't have any international activities, we have international activities due to investments or alternative investments, we conduct activities internationally, we control international NGOs or companies, or we have multiple activities internationally. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. And I think we can go ahead and close this out. Lauren, back to you.
Awesome. So 61% don't have any international activities, which is great because I can just kind of jump through some of these provisions and leave those for those who do as a point of reference. There are a couple things that impact nonprofit organizations, whether you directly own an international organization or you have international activities via a K-1. Those would be really the one-time transition tax as well as global, the GILTI tax income. What happened is the Congress with the Tax Cuts and Job Act changed the way that we tax international income. And so for certain organizations, there is what's most significant is that, this 965 transition tax, this happened with that change in tax regime. And so there's a one-time tax on the repatriation of international income from overseas activities via either K-1s or your direct ownership in a nonprofit, an NGO, control of an NGO, foreign NGO, or a controlled foreign corporation internationally. That doesn't really hurt an organization's tax. If for nonprofits, that one-time repatriation is considered a dividend, so it's not UBI income generally for nonprofits. But what it does do is it creates some reporting burden. We have to recalculate your E&P for that organization through its lifetime, and that one-time repatriation, we have to report what that repatriation 965 amount would be. Going forward, if you have these controlled foreign corporations or a foreign NGO, the way that we report the income in the future is according to a GILTI provision, and so this global intangible low-tax income is the new tax regime for foreign organizations, and so it affects reporting on a go-forward basis. A couple other quick areas of the Tax Cuts and Job Act, which we've gotten some guidance on, but nothing permanent, no regulations yet, is the university endowment and excise tax. That's the 1.4% excise tax that applies to endowments of colleges, certain colleges that meet the standard. That only impacts a select few organizations, a lot of the East Coast schools, a lot of very established schools that have really, really large endowments. It's something that's, going to be a very difficult item for them to figure out and calculate. We did get a notice 2018-55 that walks through tracking of the gain from donated securities and tracking of donor basis and provides a little bit of relief for those organizations when it comes to historic assets within their endowment. And so that's something that we're hoping for more clarifications or maybe even repeal on that. And the final item that we have is the compensation, the 21% compensation excise tax. This is something that we did get some clarification on in December, at the end of December, actually New Year's Eve, we got notice 2019-09, and that clarified how we treat compensation excise tax, the compensation excise tax, and how we calculate that. That's applicable for fiscal year starting after 1/1/18. So a lot of organizations are facing this right now. Basically what that does is it says that organizations will calculate this tax based on W-2 income, even if you're a fiscal year-end filer. For that first transition year where you're you started, it's applicable as of your fiscal year end. If you're a fiscal year filer, there's some adjustments to the W-2 income that you have, but going forward it'll be W-2 income. It also clarifies applicable tax-exempt organizations for whom this is applicable to. It would be 509. Certain governmental organizations are not yet included as with this tax. Neither are like related corporate organizations, or corporations are not included in this. However, if you have a consolidated group where you have a nonprofit, a governmental entity, if you have corporations, every organization in a controlled group is liable for their share of this 21% excise tax. There's a limitation if you only provide less than 10% of your efforts for a nonprofit organization. There's some limitations allowed for this 21% excise tax. And it's also another note that the common law employer is liable for the tax, the person that has the rights for hiring and firing an employee. If you have a payroll organization that runs your payroll, it's still something that's applicable to you. So 1 minute over, not too bad for a lot of dense information. But we do have a lot of firm resources that go into this. Always reach out to us with questions. We didn't get a chance to go through Q&A today, but please reach out to any one of us or go online to any of these great resources, and I'll throw it back to Emily to close out.
Awesome. Thank you, Lauren, and thank you, Patty, for a great presentation today. We did cover a lot of material, and unfortunately we don't have time for a live Q&A. If you have questions for Patty or Lauren, you can still submit those in the Q&A window, and we will do our best to respond to questions that came in throughout the presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.